Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So a lot of the companies in this portfolio have already reported earnings, and what we're going to do today is look at one of the companies that has reported recently, see what they've reported, see the financials, if anything has changed, and I'm going to tell you exactly whether it's a buy, sell, hold, and exactly what I'm going to do, inshallah. And then at the end we will compare it with the S&P 500, inshallah. As always, if you have not liked the video already, please do so, because it makes a huge difference. And the reason I always said this is because the more people like the videos, the more the algorithm actually will recommend to other people, and then hopefully we can reach a lot more brothers and sisters out there. If you can just press that like button, that will make a huge difference. And of course, if you can afford about 15p per day, that will definitely help the channel as well. And you can get access to the family portfolio, all the buys and sells that I make regularly, and top of that you get a lot of things out of there, including the Discord access, inshallah. The company we're going to talk about today is EOG Resources. This is one of the oil companies, one of the only energy company that I own in this portfolio. As you can see, a year to date, basically for the 1 year is almost a flat. A year to date is just about 5% up, and in the last 6 months about 13% up, which is quite nice. And it's kind of newish to the portfolio. So what we're going to do now is just look at the financials, what they've recently reported. Okay, and as you can see, both top line and the bottom line was actually a beat, which is quite nice. They generated $1.4 billion of free cash flow, which is excellent to see. Basically, they've declared they will be paying 91 cents per share in terms of dividend side of things, and they're buying back their own shares, 690 million of shares, which means basically year to date they are buying back about $1.4 billion of their own shares, which is quite nice. I like when companies are buying back their own shares, they're paying you dividends. This is how they reward shareholders. The reason why it's good when companies buy back their own shares, especially when it's it's trading at least a cheap price at that point, is nice to the company. The fact that they're buying back their own shares. And for us, if you own one share, that share is now worth more than it was before, so which is quite nice for us to see. So everything the company has reported was absolutely fine. Since then the stock's been up a little bit. So what we're going to do now is just look at the financials. Okay, like I said to you, this is one of the energy or oil company, exploration and production company. They're currently trading $126 per share. EPS is about 12.99. Market cap right now is 772 billion market cap, and it has a narrow economic mode. Beta is slightly high, and current P is about 9.8, and the forward P is about 10. The 5-year average is about 11. So based on the 5-year average, this tells us it is trading slightly at the discounted price right now in comparison to the sector. Sector is about 12 right now, and the S&P 500 currently last trailing 12 months is trading about 26. Price to free cash flow about 14. Now, in terms of dividend yield, 2.8%, which is quite nice to see, and that gives you about $3.56 of every share of this company that you own. The payout ratio right now is about 28. The latest increase was about 10%, and the 5-year growth rate of 33%, which is absolutely huge. You don't see that there are so many, basically that many companies increasing the 5-year basically growth rate of about 33%. I've not seen that. I think Broadcom used to be about around this a while ago, but then again they slowed it down for a bit. Now this could potentially happen, but this company has been increasing the dividends only for the last 6 years. The dividend safety is 82%, which is absolutely perfect. Anything above 61% is a save. Free cash flow right now $5 billion. Check this out. Free cash flow compound annual growth rate for the last 5 years is 20%, which is really huge. Free cash flow yield right now about 7%, which is really great, and free cash flow margin of 21%. So when it comes to free cash flow, these companies are absolutely amazing. Now, profit margin 31%, operating margin of 37%, and return on equity of 27%, and return on invested capital of 24%. So in terms of what the management are doing, in terms of profitability, absolutely amazing job so far. The net income, the compound annual growth rate for the last 5 years, we're looking at about 16%. And the total return in the last 10 years, including dividends and everything else, is about 4%. So revenue growth in the last 5 years about 7%. The EPS is growing fast, about 15%, and current ratio is way above 1. Normally we're looking for 1 or more, but right now it's over 2, which is quite nice to see. Now, in terms of growth expectations for next year is only 4%, but after that, they're expecting every single year basically the EPS to grow about 7%, which is absolutely huge. Now, if we go back here and just go to financials, just to quickly have a look at what they're expecting. Okay, so this year about 5%, the next year about 4%, the next year about 2% there, and then negative. So again, if we just focus for the first three, okay, nothing huge to worry basically really scream about. But then again, you oil companies, you can't expect that. Again, it depends on the oil prices. If the oil prices is basically doing amazing, these companies tend to do well. So about 2%, 3%, about 4%. So that is the kind of thing what you basically that you expect from these companies. So on average, if you bear every single year, if you grow, basically they grow in 7% in the EPS. That's absolutely amazing. So we've seen current price already $126 per share. According to Morningstar, they're saying it's 124, so it's fairly valued right now. So just about $2 are higher than where lower than where it basically should be, apparent according to them. Fair value for Simply Wall Street is absolutely ridiculous, $224 per share. That's 43% upside from where we are right now, which is absolutely crazy. When it comes to price, the tip rank, for example, next 12 months they're expecting about 146, which is a bit more realistic. And also according to that's about 15% upside and moderate buy. Now, according to Seeking Alpha, 144, more or less the same, 13-14% upside from where we are, and it's also a buy from them. Now, looking at the Sharia compliance side of things, so nothing to worry about in terms of business screen. In terms of interest-bearing debt, 6%, and interest-bearing securities, about 7%. Now, in terms of shares, as we've seen already, they are actually planning to buy back their own shares, and as you can see, that's probably why it's slightly lower than basically where it was last year. They were buying back their own shares, then they basically diluted it a little bit, and then after that they started buying back that again diluted again, and so it's up and down kind of thing. But right now it looks like they're actually buying back their own shares, which is quite nice to see. Now, in terms of valuations, we're taking Morningstar valuation, we're taking Seeking Alpha, Simply Wall Street, multiple valuation model that I used, and the discounted cash flow model that I used, discounted model that I used. All of that together will, based on average, that gives us $155 per share. Current price is 126. That gives us about 23% upside from where we are. If we say, you know what, these companies are very volatile, whatever, let's take 15% or even 10%. Okay, you still is still undervalued. So 140 is basically where we are. If we say, you know what, we're going to be absolutely crazy and basically say 15%, you still $132 per share, so you can still basically get this stock. Now, I'm not saying this is not financial advice, as always. I'm not saying go and buy this stock right now, but of course you have to do your own research. I'll show you exactly how many shares of this company that I own. But before we get to that, so right now, if you were to buy at this price 126, I think you will have about 23% upside from where we are based on this. But it looks like even Morningstar basically valuation is not far off from there, so which is absolutely fine. Seeking Alpha, and maybe this is slightly higher, but these two also very similar to Seeking Alpha Analyst and so on. But Simply Wall Street, for some reason, is just crazy what they coming up. I don't know what they used, but that's they use the discounted cash flow model. I guess the fact that this company has an excellent free cash flow right now, maybe they're using that. Whatever the case, that's their price right now. If we take it out, if we just use the 4 here and take out Simply Wall Street valuation here, it's still $138 per share, so it's still higher than where we are right now, and that gives us about 9% upside. And if you said I need a 10%, okay, again $124 per share, you can start buying, which is basically what Morningstar actually said initially. So absolutely great company. I like the business model. I do own it, and I'll share that with you guys in a second. But before we do that, I want to share with you guys basically how it's actually trading against how it's performed against the S&P 500 and some of their competitors. So we're looking at a couple of companies, for example, ZVX, which is Chevron, ExxonMobil, Devon, and so on. So as you can see here, for the last 5 years, if we just look at the 5 years, you can see 123% in terms of total return. The S&P 500 less than 100. Devon is actually done about 173. With ConocoPhillips, we've got 166. Exxon is about 120, and CVX is about 60. Now that's Chevron. And then when it comes to last 10 years, 50%, 181, minus 17%, 88%. Remember, oil companies have not done well over the last 10 years. So it's only last since COVID. After COVID recovered, basically they recovered quite a bit. Before COVID, they were not doing really well at all. And remember, because when COVID hit, the oil prices went to literally for free, that you can just take away for free, and for that reason a lot of these companies suffered a lot. So for that reason, that's why probably it's down a lot. But 50% in the last 5-10 years, but last 5 years is about 123%, which is a bit more realistic if you think about it. Now let's talk about how many shares of this company I own. Right now I own 27.7 shares. I have been buying back this basically a few shares here and there last couple of weeks, and I'm going to continue buying it, okay, while it's still trading around here. So my average right now, as you can see here, is $122 per share, and all £96 right now. So 122. So if it comes down a little bit, I'll buy more. If it stays where it is, I don't really care because of the FX basically impact. As you can see, I'm down about 4% based on that, but on average I'm basically should be slightly higher. But anyway, what I'm going to continue doing is, inshallah, buy a bit more shares of this company. Potentially I would like to get to 40 shares, inshallah, and maybe about £4,000 worth of shares, and we'll see what happens from there onwards. Anyway, that's the company I wanted to share with you guys. I hope you're enjoying this type of content. If you are, please like the video, subscribe to the channel, and let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.